take that conversation forward now. Joining us live is Jahangir Aziz, the MD and Head for Emerging Markets Economics Research at JP Morgan. We're also being joined by James Knightley, the Chief International Economist at the ING. Good morning, gentlemen. Thank you so much for joining us live today morning on ET Now. Jahangir Aziz, I'll come to you first. We've seen what's happened overnight on Wall Street. Markets, waiting for this event to get done with. They now know which way it's going to be headed as far as tapering goes and all of that. The question I think all of our viewers in India will want to know is what is this going to mean for capital flows? India is a market which has outperformed the rest of the world. It has shown resilience. This is not the same India after Lehman Brothers, which would have seen a big knock once the quantitative easing program was being wound down.
Look, as far as emerging market capital flows are concerned, they will take, it is strongly driven by what is happening to U.S. asset prices. So the fact that the U.S. Equity market, and we need to separate equity market from fixed income market, that the U.S. equity market thought that the Fed announcement was either in line with what they believed in, or came in a bit dovish. It definitely was more dovish than what we had been expecting. It means that at least the equity side of US equities will be supported at least for in the near future, and that always is a good attractor for emerging market flows. And again, we do not expect a disruptive pickup in U.S. Fed funds rate. The 10-year has hardly moved at all. It hasn't moved for a long time. The 10-year matters a lot for emerging market funding. And I think that the fixed income market is probably telling us something somewhat different from what the equity market is telling us. But for the time being, I think that emerging market flows remain reasonably supported by whatever their domestic conditions are. So countries that showing reasonably strong growth will attract capital flows. Countries that are struggling will find it difficult to attract flows at this point in time.
James Knightley, come in there. You've heard how, what the views of Jahangir Aziz are at the moment, but with this war against inflation being declared by the FOMC, central banks, other central banks like that of India, will they be considering a rate hike faster now?
Well, my personal view is that this was a big leap of faith, actually, from the Federal Reserve. To raise your growth forecasts, to go from one rate hike in 2022 to three rate hikes in 2022, when we are in the midst of another wave of the pandemic. And you can see the COVID containment measures coming in across Europe. There is the potential that we do see, at the very least, consumer caution here in the US, some weaker growth coming through January, February time. I think it was a very bold step. And I'm not sure that most of the major European central banks are in the same position as the Federal Reserve is. Yes, inflation pressures are rising, but the economic outlook, especially in the near term, given these extra containment measures, is much tougher. So I'm just a little bit wary that this optimism about near-term growth and everything bouncing back and don't worry about a thing, it's a bold assertion to make in this current time. So I'm just a little bit cautious. And I think, we've got the Bank of England, we've got the ECB today. I really can't see the Bank of England hiking today. I think February at the very, very earliest, and that's on the assumption that the UK doesn't go into more lockdowns, which is a distinct possibility. Likewise in Europe, we're seeing broad lockdowns, broader containment measures coming through, and of course, consumer caution. Again, I think the ECB has very much a reputation for being much more dovish on these sorts of aspects. So I still think an ECB rate hike is not going to be happening this year. There are pockets. Canada, certainly, I think Canada is going to be raising rates in 2022, possibly Norway as well. But for the majors, the Swiss, Japan, the ECB, the Bank of England, I think it's going to be a far more cautious, far slower path than perhaps the Federal Reserve is alluding to right now.
From a comment which was in October where Fed felt that inflation is transitory, now the word transitory has been substituted or changed with the word stubborn. What is in store for 2022 for the world then? A fight against inflation starts again, the famous war against inflation?
From my side, I think we have to be alive to the risk that the Fed does change its view quite rapidly. And we've seen that throughout this year. Remember back in March, the Federal Reserve was saying, don't worry, we're not going to raise rates until 2024. 3 months later, they said, oh, actually, it's going to be 2023. 3 months after that, it's actually going to be 2022. 3 months after that, it's not one hike, it's 3 rate hikes. The Fed can change its view quite quickly. And if we do get a little bit of bad news, I think the Fed will change its view once more. It is alive to the threat. So I think, this sort of nice glide path that the markets are factoring in, everything's going to be nice and smooth, don't worry. I think 2022 could be quite an eventful year and quite a bumpy year as well, I think.
Jahangir, the Fed is changing their view based on data which is available with them, but markets unfortunately have to position themselves for not what has happened but what will happen. How do you see the positioning, Jahangir, in 2022 for the word risk changing, given that if interest rates they go higher, it will surely lead to asset prices coming down?
So the two markets, as I said, I think we are focusing way too much on the equity market. So the equity market is taking what the Fed is saying, that this wasn't as bad as they thought it was going to be, and the equity market has rallied. The fixed income market isn't saying that. The fixed income market, after seeing these kinds of glide path, should have reacted much more aggressively. So there are two things that is happening right now. So we are in the camp that the Fed can raise rates. In fact, we had even a higher path than 2.1% as the terminal rate. We had a 2.5%. We have a much stronger employment number going through, and the unemployment rate is going to be lower than the 3.5% that the Fed has. And more importantly, we also believe that this time it is different. This time it is different, that unlike the 2015-18 rate hiking cycle, this time the US economy and large parts of the global economy have strong enough balance sheets, have strong enough resilience and enough amount of private savings in order for this rate hike to be absorbed, i.e. that the economy and the asset markets will be resilient to this pretty large rate hiking cycle that has been signaled by the Fed. The equity market is also buying that story at this point in time, that the asset prices and the economy will be resilient to it. But look at the fixed income market. The fixed income market is basically saying this time is not different. This time is exactly the same as 2015 and 18. And that at some point in time, which is your fear, at some point in time, either growth, that is the economy, is going to react badly to the rate hikes, or the asset prices are going to react to the rate hikes. So we are sort of caught between these two things. Again, our view is that this year, 2022 is very different. The world will be able to absorb this kind of a rate hiking cycle simply because it's very different in terms of balance sheet exposures. It is very different in terms of the kind of savings that exist, both excess savings that exist both in developed markets as well as in emerging markets. But unfortunately, that's not what the fixed income market is saying. And one has to make a choice. Is the fixed income market going to be right, or the equity market going to be right?
Only time will tell. But Jahangir, so great to have you on the show. James, good to speak with you as well.